Welcome to Wealth Echelon, your go-to destination for expert insights on finance, stocks, and ETFs. Our mission is to empower you with the knowledge and strategies needed to navigate the financial markets with confidence. Whether you're a beginner looking to build a strong investment portfolio or an experienced investor seeking market trends and analysis, we've got you covered. Join us as we break down complex financial concepts, explore market opportunities, and help you climb the ladder to financial success. Subscribe now and take control. Imagine a future where you no longer have to rely on a paycheck to cover your bills. No more commuting, no more office politics, no more waiting for payday. Just steady, reliable income flowing into your account month after month. While it might sound like a distant dream, the path to financial independence is more accessible than ever, thanks to a simple and powerful investment strategy. By committing to invest just a small amount each week into a well-diversified portfolio of high-quality stocks that pay regular dividends, you can set yourself on a course toward financial freedom. The magic behind this strategy lies in the power of compounding, reinvesting the income generated from your investments to create even more income over time. Even with relatively modest weekly contributions, the effects of compounding, coupled with the growth of the underlying stocks, can snowball into a significant portfolio that produces passive income capable of replacing or exceeding a full-time job's salary. This strategy is not about taking risks on speculative stocks or hoping for a quick windfall. Instead, it's about steadily building wealth with proven, reliable companies that reward shareholders with regular dividends. Over the years, these dividends can grow, and as your investment grows, so too does the income it generates, allowing you to eventually break free from the constraints of a typical job. By making consistent contributions and allowing your money to work for you, you can transform a small weekly investment into a stream of passive income that sustains you long after your active working years are behind you. The key to success is starting early, staying disciplined, and taking advantage of the compounding effect. Investing has always been a key method for wealth accumulation, and exchange-traded funds, ETFs, have become one of the most efficient and accessible ways for individual investors to grow their portfolios. Among the many ETFs available, SCHD, the Schwab U.S. Dividend Equity ETF, stands out as a powerful investment vehicle for long-term growth and passive income generation. The idea that investing just $200 per week into SCHD could eventually surpass the income of a full-time job may seem far-fetched at first, but when considering the effects of compounding, dividend reinvestment, and the stock market's historical growth trends, it becomes a compelling financial strategy. SCHD, the Schwab U.S. Dividend Equity ETF. SCHD is an exchange-traded fund designed to track the performance of the Dow Jones U.S. Dividend 100 Index. It primarily invests in high-quality U.S. companies that have strong dividend histories, stable earnings, and solid financial health. This ETF is particularly attractive because of its low expense ratio, currently 0.06% strong dividend yield, typically around 3% to 4%, and a focus on companies with sustainable dividend growth. By investing in SCHD, individuals gain exposure to a diversified portfolio of dividend-paying stocks without the hassle of selecting and managing individual stocks themselves. One of the fundamental reasons why investing $200 per week into SCHD can lead to substantial wealth accumulation is the power of compounding. When dividends are reinvested, the returns generated from an investment begin to earn returns of their own, creating a snowball effect over time. SCHD's dividend yield, combined with stock price appreciation, creates a dual source of growth that can exponentially increase an investor's portfolio value over decades. Let's break down the numbers. Assuming an average annual return of 8%, a conservative estimate based on historical performance, an investor contributing $200 per week, $10,400 per year, into SCHD could see the following results. After 10 years, approximately $160,000. After 20 years, over $500,000. After 30 years, over $1.5 million. These figures assume consistent contributions, reinvestment of dividends, and an average return over time. While past performance does not guarantee future results, Historical trends suggest that long-term investing in high-quality dividend ETFs like SCHD can lead to significant wealth accumulation. A full-time job provides active income, meaning you trade your time for money. However, with a well-structured investment strategy, passive income from dividends and capital appreciation can eventually replace or even surpass your job earnings. The key is reaching a portfolio size where dividend payouts alone can cover or exceed your living expenses. SCHD currently has a dividend yield of around 3.5% to 4%, meaning for every $100,000 invested, an investor could expect to receive approximately $3,500 to $4,000 per year in dividend income. Based on this metric, the potential annual dividend income at different portfolio values would be $250,000 invested, $8,750 to $10,000 annually. $500,000 invested, $17,500 to $20,000 annually. $1 million invested, $35,000 to $40,000 annually. $2 million invested, $70,000 to $80,000 annually. For many people, an investment portfolio of $1 to $2 million is enough to replace their job income entirely, allowing them to live off dividends while preserving their principal investment. The role of consistency and patience. The key to achieving financial independence through any investment vehicle, whether it's dividend-focused ETFs or individual stocks, is consistency and patience. Investing $200 per week might not seem like much at first glance, but over time, those small, regular contributions can compound into substantial wealth. The most successful investors often emphasize the importance of starting early and allowing time for growth. The earlier you begin, the more time you give compounding to work its magic, turning even modest investments into large sums over several decades. While the power of compounding is significant, market fluctuations are an inevitable part of the investing journey. There will be times when the stock market experiences volatility, whether due to economic downturns, geopolitical events, or market sentiment shifts. However, for long-term investors, these fluctuations can be seen as opportunities rather than setbacks. By sticking to a consistent investment strategy, particularly one focused on dollar-cost averaging, DCA, you can mitigate the effects of market timing. DCA involves investing a fixed amount of money at regular intervals, regardless of market conditions. This strategy ensures you buy shares during both market highs and lows, which can lower your average cost per share over time. In the long run, this can result in purchasing more shares when prices are low and fewer shares when prices are high, smoothing out the effects of market volatility. One of the important advantages of long-term investing in high-quality dividend-paying assets is the ability to accumulate wealth even during market corrections. Investors who have a steady and disciplined approach don't panic during market dips, as they understand that these periods are temporary and often provide opportunities to acquire shares at lower prices. Moreover, dividend payouts can offer a steady stream of income, even when stock prices are fluctuating. For investors committed to reinvesting those dividends, the power of compounding intensifies, as the dividends earned are used to purchase more shares, which then earn their own dividends in the future. Tax implications are another important consideration when investing in dividend-paying assets. Dividends are typically subject to taxation in taxable brokerage accounts, which can diminish the returns that investors earn. Qualified dividends are generally taxed at a lower rate than ordinary income, but they still represent a tax liability. However, using tax-advantaged accounts, such as a Roth IRA or a 401k, can offer significant tax benefits. Contributions to a Roth IRA, for instance, grow tax-free, meaning that dividends, capital gains, and interest can accumulate without being taxed as they're reinvested. Once you reach retirement age, qualified withdrawals are also tax-free, allowing you to access your wealth without the burden of taxes. Similarly, 401k plans allow for tax-deferred growth, which can be beneficial for long-term wealth accumulation. Using these types of accounts can enhance the growth potential of your investments by allowing more of your returns to remain invested in compounding. Comparing SCHD to other investment options. While SCHD is an excellent ETF for dividend-focused investors, it is important to compare it to other options such as S&P 500 ETFs, SPY, VOO. These funds track the overall market and tend to have higher growth potential but lower dividend yields. High-yield dividend ETFs, VYM, HDV. These focus on higher-yielding stocks but may not have the same quality filters as SCHD. Individual stocks. While investing in individual dividend stocks can be lucrative, it requires significant research and risk management. SCHD offers a balance of dividend income, capital appreciation, and diversification, making it an ideal choice for those seeking passive income and long-term wealth accumulation. Overcoming inflation and economic downturns. A common concern among investors is the impact of inflation and economic downturns. While inflation erodes purchasing power, dividend-paying stocks historically provide some level of protection as companies tend to increase payouts over time. SCHD focuses on companies with strong financials, making it resilient during economic downturns compared to riskier investments. During recessions, dividends may be at risk of cuts, but high-quality companies within SCHD are more likely to maintain or even grow their payouts. Additionally, bear markets present buying opportunities for long-term investors who can acquire shares at discounted prices, further enhancing future returns. The path to financial freedom. Financial freedom is the ultimate goal for many investors. By systematically investing $200 per week into SCHD and allowing compounding to work its magic, individuals can build a portfolio capable of generating significant passive income. This strategy requires discipline, patience, and a long-term perspective, but the rewards can be life-changing. Ultimately, investing in SCHD provides a reliable and relatively low-risk way to achieve financial independence. Whether the goal is to retire early, supplement existing income, or build generational wealth, consistent contributions to a high-quality dividend ETF like SCHD can pave the way to a future where passive income surpasses a full-time job salary. By starting early, staying consistent, and leveraging the power of compounding, anyone can take control of their financial future and achieve long-term wealth. That's it for today's video. If you found this helpful, don't forget to like, subscribe, and turn on notifications so you never miss an update. At Wealth Echelon, we're all about helping you navigate the world of crypto, investing, and financial growth. Have any thoughts or questions? Drop them in the comments below. I'd love to hear from you. Stay sharp, stay invested, and I'll see you in the next one.